Today we will be covering the topic the accounting equation. We will be discussing about the meaning of assets, liabilities and owner's equity. We will understand and apply the accounting equation and there will be an overview of the double entry system of bookkeeping. So let's begin now. Assets, liabilities and owner's equity, which is also called capital. Assets are resources of monetary value, that is, we can measure them in money terms that a business owns or are owed to the business. For example, cash, motor vehicles, and trade receivables, debtors. A motor vehicle is something that a business is using to carry out its day to day functions or to run the business. This motor vehicle could either be financed by the owner or through loan money. We will get more clarity on assets after we know a bit about all three. Liabilities are amounts that a business owes people for resources supplied to the business. For example, bank loan, bank overdraft, which is similar to a bank loan, but it is the ability to withdraw some more money than your account has. But we will go in further details in the upcoming chapters, or trade payables, which are the creditors of the business. Now, the third thing is owner's equity or capital. It is the amount of money that the owner of a business has invested in it. It is what's left after subtracting liabilities from assets. Now, let's discuss all three. Owner's equity is the amount of money that a owner brings into the business. Liabilities are the amount of money that a business has to pay other people, such as if a bank gives a loan to a business, that will be a liability which we have to repay to the bank. And assets are resources of monetary value that a business owns or are owed to the business. Now we will get further clarity on assets, liabilities and owner's equity through the accounting equation. The accounting equation is that owner's equity is equal to assets minus liabilities, which can also be written down as liabilities is equal to assets minus owner's equity, or assets is equal to owner equity plus liabilities. I would recommend you to memorize this one. Assets is equals to owner's equity plus liabilities, which means that anything that a business has, motor vehicle, cash or anything of monetary terms that a business has, is either financed through owner's equity, which is the owner's money, or through liabilities, which is the money owed by the business to other people. So the accounting equation, which is assets is equals to owner's equity plus liability, means that all assets owned by the business are either financed through the owner or through loan money. Both the sides should have the same value. This makes sense as it shows all assets of a business are provided or funded either by the owner or the trade payables or creditors of the business. Now let's discuss some definitions which we will require to understand this further. Inventory refers to the goods that a business purchases for resale purposes. Drawings is the term given to the value of assets which an owner withdraws from the business for their personal use. Drawings reduce the owner's equity. Basically, anything that a business gets from the owner is owner's equity, and if owner draws some of it, owner's equity will be reduced. Trade receivables or debtors are businesses or individuals who have received goods or services from the business, but they have yet not paid the money. So they have to pay the money in some time. So as cash is an asset, so is trade receivable or debtor, because this is money that we will receive from these people in some time. On the other hand, trade payables are businesses or individuals from whom the business has received goods or services and have not yet paid money to them. So this is basically a liability. We as a business will have to pay them in some time. We can further subdivide assets and liabilities into two categories: current and non-current. Current is the term used for less than 1 year and non-current is the term used for more than 1 year. So any asset that is likely to be with us for less than 1 year is a current asset, such as cash, bank, or trade receivables, that is the debtors. Non-current assets are those assets which are likely to be with us for more than a year. This could include machinery, motor vehicles, buildings, and premises. Current liabilities are those debts that must be paid within 1 year. These could include trade payables, that is the creditors, or a bank overdraft. And non-current liabilities are those debts which we can pay after more than a year. These usually include bank loan and debentures. You might not have an idea of what a debenture is yet, but that's okay. Overview of the double entry system of bookkeeping. As we know now that the accounting equation is assets is equals to owner's equity plus liabilities. So if one asset increases, on the other hand, either owner equity will increase or liability will increase. If assets decrease, then either owner's equity will decrease or liability will decrease. If one asset increases, another asset might decrease. So accounting equation will have to stay balanced. That is, every economic or business event will have a dual effect on the accounting equation. This can be seen in the statement of financial position. Statement of financial position also shows that assets is equals to owner's equity plus liabilities, and both sides should be equal. The statement of financial position of a business is a statement listing assets, liabilities, and owner's equity at a specific point of time. Usually it is prepared at the end of the financial year at the last date. Now let's discuss this with the help of an example. On 2nd Jan 2018, Anita opened a bank account for the business named Anita Goswell Trading. She deposited 56,000 cash into this account. Now what would the double entry look like? The entry would be that assets would increase by 56,000 because cash is an asset. And at the same time, owner's equity would also increase by 56,000 because owner's money is being invested in the business. Moving on 5th January 2018, Anita purchased inventory for $5,000 paying by check. So, out of that 56,000, 5,000 has been used to pay for inventory. And inventory once again is also an asset. So here we can see that now we have 5,000 worth of inventory. Cash at bank had reduced by 5,000. So total assets are still 56,000 and owner's equity is also 56,000. Moving on 6th January 2018, Anita Goswell Trading bought a motor vehicle costing 6,000 from Salient Motors on credit. Now we can see that asset is increasing and a liability is also increasing. Salient Motors is now a creditor and must be paid back at some later date. So now if we look at the statement of financial position, the asset section includes a motor vehicle for 6,000, the same inventory for 5,000 and the same cash at bank for 51,000. Total assets have now increased to 62,000. Owner's equity remains the same at 56,000 and now a new liability is added in the form of Salient Motors, that is a creditor, which is 6,000. So once again, assets is equal to owner equity plus liability. It is being shown by 62,000, that is the total of the assets and also the total of the owner's equity plus liabilities. On 25th Jan 2018, Anita paid Salient Motors 5,000 by check in part payment of the debt owing. The debt was of $6,000. Now 5,000 has been paid. So cash at bank would reduce by 5,000 because we are paying by check, and the debt owed would also reduce by 5,000 and now only 1,000 will remain as the debt. Now let's see this in the statement of financial position. Motor vehicle remains same, that is 6,000. Inventory also remains unchanged, that is 5,000. Cash at bank will reduce by 5,000 from 51,000. Now only remaining is 46,000. So total assets are 57,000 and owner's equity was 56,000. It is still the same. Liabilities has reduced from 6,000 to 1,000 because 5,000 we have paid. So the owner's equity and liability total is also coming at 57,000. The statement of financial position is balancing. On 29th Jan 2018, Anita sold inventory for cash 3,000. So now inventory will reduce by 3,000 and cash in hand would increase by 3,000. This is not cash at bank, this is cash in hand. They are both different terms. So now we can see that motor vehicle is same 6,000, inventory has reduced by 3,000, now it is only 2,000. Cash at bank remains same, which is 46,000, and cash in hand is now 3,000 because we got cash by selling the inventory. So the total assets are still the same, 57,000. Owner's equity and liability section remains unchanged and the total is still 57,000. On 30th Jan 2018, Anita withdrew, this is drawings, 3,000 from the bank for her own personal use. So we have already discussed that when an owner takes an asset from the business, that asset reduces and owner's equity also reduces. So now we can see motor vehicle remains same in the SOFP, inventory is same, cash at bank has now reduced by 3,000, it was 46, now it is 43,000 because Anita, the owner, took some money out of the business. Cash in hand remains same, so now total assets are 54,000. And in the liabilities and owner's equity section, we can see that owner's equity opening balance was 56,000. But since Anita withdrew goods or cash worth 3,000 from the business, her owner's equity will now reduce by 3,000, that is the drawings. So owner's equity's total is now 53,000 and liabilities are same, that is 1,000. So the total of the owner's equity section and the liability section is now 54,000. So statement of financial position is still balancing. On 31st Jan 2018, Anita paid Salient Motors 1,000 cash from her own personal funds. Not the funds of the business, but her own personal funds. So this is basically an increase in owner's equity of 1,000 and a reduction in liability of 1,000. So now we can see motor vehicle remains same, that is 6,000, inventory is same 2,000, cash at bank 43,000 is also same, cash in hand 3,000 is also same. So basically all the assets remain same. There is no change in the asset section of the accounting equation. Assets are 54,000. Now the liability, the creditor Salient Motor has reduced by 1,000, which was the total amount of the liability. So liabilities vanished from the statement of financial position. But there is a reduction of 1,000 in the liability and there will be an increase of 1,000 in the owner's equity section. So owner's equity will now be 54,000 instead of 53,000 because technically Anita bought 1,000 cash into the business, which she immediately paid for the payment of creditor. So this is all in this chapter.